yet honestly misunderstood challenges in all of personal finance. We are looking at a grounded, totally data-driven blueprint for turning $1,000 into $100,000. I'm going to guide you through a really fascinating set of research, strategies, and case studies to show you exactly how it's done. So, how do you actually turn $1,000 into 100 grand? I mean, if you search around online, you are going to hear a ton of noise about getting lucky on some speculative bet or risking it all on extreme leverage. But what if we want a realistic plan? A plan backed by actual market data, real entrepreneurial case studies, and solid math. Well, that is exactly what we are going to build today. Think about it. When most people get their first extra $1,000, what's the amateur move? They buy a depreciating asset, like a flashy, crystal-studded watch. The host of The Minority Mindset actually shared a great story about doing exactly this back in high school, only to quickly realize that a sparkly watch is essentially just a very shiny anchor for your net worth. The true professional move is investing that seed capital into active income. It's about buying the skills and the equipment that actually multiply your earning power. To actually hit that $100,000 target, we are going to follow a 6-phase realistic blueprint: investing in your skills, building a side hustle, unlocking the microcap advantage, hunting for multibaggers, utilizing the math of compounding, and finally, learning how to avoid ruin. All right, phase 1. Invest in your skills, the seed phase. Listen, the absolute highest initial return on investment you will ever get, it won't come from a stock chart. It's going to come from investing in yourself, because you simply cannot compound zero. Say you take that initial $1,000 and you buy a decent used camera. For the next 2 years, you obsessively master photography. You start taking on clients. Then, instead of just spending those earnings, you reinvest them to scale your side business, maybe buying better lighting or hiring an editor. The whole goal here is to drastically increase the velocity of cash coming into your life. Moving on to phase 2, build a side hustle, active income. Once you've developed a base skill, it's time to formalize it into a predictable cash flow engine. There's this fascinating case study about a guy named Ryan Finley, who literally pulled himself out of $25,000 in debt, starting with just $200. The steps are beautifully straightforward. You find undervalued items locally, like appliances or bikes. You buy them low, and then you sell them high on platforms like Craigslist or Amazon FBA. You keep the margin. This active strategy rapidly compounds your starting capital long before you ever even open a brokerage account. Phase 3, the Microcap Advantage, the multipliers. So eventually, your active income is going to generate more cash than you can physically manage yourself. That is exactly when you shift your focus to the stock market for passive multipliers, starting with true microcaps. We are talking about companies with a market value between $50 million and $200 million. Now, why do we care about that specific range? Because large hedge funds simply cannot invest in them. They're just too small to move the needle for a billion-dollar fund. And that means they are chronically under-researched, which gives regular retail investors like us a massive structural advantage. And guys, the historical data on this is absolutely staggering. A backtest running over a 45-year period from 1970 to 2015 found that investing in the cheapest 10% of U.S. microcap companies yielded a return of 64,900%. To put that into perspective, a $10,000 investment grew to over $6.5 million, adjusted for inflation. It just proves that there is incredible mispricing hidden in the smallest corners of the market. Which brings us to phase 4. Hunting for multibaggers, the alchemy of outperformance. So how do we actually pick the right microcaps? We are looking for multibaggers. These are stocks that increase in value 10, 20, or even 100 times your original investment. I absolutely love this quote from Thomas Phelps' legendary 1972 study on 100 backers. He said, "To make money in the stock market, you must have the vision to see them, the courage to buy them, and the patience to hold them." We really need the psychological fortitude to hold on to these high-growth companies over the long haul, right? You have to avoid the temptation to cash out for a quick 20% gain when a 1,000% gain is literally on the table. Let's dig into the hard academic data for a second. A 2025 study by Anna Yartseva analyzed 464 modern multi-bagger stocks to see what they all had in common before they exploded. What she found is a clear checklist. You want to screen for a high and positive free cash flow yield. You want aggressive investment policies, but, and this is absolutely crucial, that asset growth must be supported by matching EBITDA growth. In simple terms, they're expanding, but they can actually afford it.
You also want a high return on equity compared to their peers. And you want to enter the position when the price-to-earnings ratio is in the low single digits. So, high quality at a dirt cheap price.
Yardsave's research also points out that your entry timing is absolutely critical for explosive growth. The data shows that multi-baggers exhibit these complex momentum effects with very quick trend reversals. So when is the absolute best time to buy? When the stock is hovering right near its 12-month low, ideally after it has fallen considerably over the prior 6 months. Basically, you're buying at a moment of maximum pessimism on a mathematically sound company. All right, Phase 5. The math of compounding. Time and risk. To really cement those calculated gains into lasting long-term wealth, we have to respect the time value of money. This is the underlying mathematical engine where your money grows exponentially over multiple periods because your accumulated interest actually starts earning its own interest. Think of it like a compounding snowball. If you constantly pull your profits out to buy toys, well, the snowball melts. But if you leave it invested, it eventually causes a massive avalanche. Let's put a concrete number to that to see what it actually means. If you take a single $1,000 investment and just let it compound at a 10% interest rate, in 20 years it grows to over $6,700. And that is with zero additional effort. Now imagine feeding that snowball continually with the profits from your active side hustle and supercharging that interest rate by utilizing the microcap strategies we just discussed. Suddenly, the path to $100,000 becomes incredibly clear. Which leads us to our final step. Phase 6, how to avoid ruin. The mathematics of survival. Look, protecting your newly built wealth is arguably way more important than making it in the first place. Check out this incredible insight from a study by Carl Whelan on asymmetric risk. A strategy with a 20-to-1 payoff sounds amazing, right? But the math reveals that if you hunt these extreme payoffs using just a 1% stake of your capital, the probability of ruin is a massive 64%. Why? Because these high payoff events are so extremely rare, the variance can completely wipe you out long before you ever hit the jackpot. So to recap the essential defensive strategies you need for smaller portfolios, you absolutely must avoid blindly chasing extreme asymmetric bets. Research out of the University of Toronto also heavily emphasizes minimizing transaction friction. Simply put, don't trade constantly because fees will eat your small portfolio alive. Keep your position sizes reasonable to protect your core capital, and stick strictly to the high-quality, data-driven screening metrics we covered earlier. Quality is what keeps you in the game. So there you have it. We've covered the complete, realistic blueprint. From investing in your own skills to generate that active cash flow, right through to using data-driven microcap strategies to multiply that cash while strictly managing your risk. So I'm going to leave you with a provocative question to think about. What skill will you spend your first $1,000 on today to start your own compounding snowball? Don't just sit back and watch this explainer. Get out there and take that first active step. Thanks so much for joining me today,